Guys, the Dow fell about 575 points today after comments from Jerome Powell about where interest rates might go. So let's take a look what his comments did to the market on where they now think the federal funds rate will now terminate before they stop raising or even think about cutting interest rates. So here they say on Zero Hedge, Powell's hawkish remarks spark cross-market chaos, rate hike odds soar. And so they continue this little game of push and pull. One guy says one thing that's hawkish, one guy says one thing that's dovish, and the market is up one day, the market is down another day based on what a few words were said by some Fed governor or Powell or somebody that they're leaking to. So here he says inflation has moderated somewhat since the middle of last year, but remains well above the FOMC's longer run objective of 2%. Now, if you watch my other video, this 2% number is already being set up to be thrown out so that they can say, well, 3 or 4% is going to be the new longer run objective. That said, there is little sign of disinflation thus far in the category of core services, excluding housing, which accounts for more than half of core consumer expenditures. If the totality of data were to indicate that faster tightening is warranted, we would be prepared to increase the pace of rate hikes. So this spooked the market right here because this can mean a intermeeting rate hike, like a surprise rate hike they do to try to shock the market down or shock the market up when they have surprise rate cuts. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. So all those people that think, okay, Fed raised by 1/4 of a point, they're almost ready to stop raising and ready to start cutting any day now, and the stock market go back to the races. This is saying otherwise. And so terminal rate expectations jumped from about 5.45 now to about 5.6%. Now with Fed funds rates between 4.5 to 4.75, that is about 3/4 of a percentage point more to raise rates, according to this. And so odds of a 0.5 percentage point rate hike in March and May have now spiked higher. And so that threw a whole lot of cold water on the stock market, waking a lot of people up from the dream that the Fed will be done raising and start cutting any day soon now. And so Treasury yields from the 2-year all the way to the 30-year shot higher, which is good for people who are staying in very short-term Treasuries. And not surprising, the 10-year note went and touched the 4% level, but it actually came back down a bit, which is a little bit surprising. What's not so surprising is the dollar spot index jumped, and with that, gold dropped about $35 to about 1820 today. That's a pretty big move. Now, the market may now just be starting to realize what the Fed probably already realizes, and that if you don't get aggressive with the inflation and smack it down hard, it could come back with a vengeance. And that's what happened in the late 70s, early 80s. So this blue line, the CPI, rose above 10%, about 11% or so, and the Fed funds rate rose to about 12%, and inflation came down. And so they thought they were done, and they lowered interest rates back down to, say, 5% or so. And what happened? Inflation came roaring back, and that's when they had to go and put the Fed funds rate above 20% to smack this thing down. So is there any sign of reaccelerating inflation? Well, used car prices are now reaccelerating with the biggest February gain since 2009. And looking at a chart of the Manheim Used Vehicle Value Index, you see it peaked at 260, came down to 220. Now it's going back up to 234.5. So it seems the Fed is trying to tell the market that it is not done raising interest rates, but the stock market still does not want to hear it, and it's going to go kicking and screaming until they finally realize it. And so from the time where only 5 or 10% of the people in the market believe it to the time where everybody accepts it now as truth, stock prices could be a lot lower than where they are now once we reach the Fed terminal rate, if it is going to be 5.6%. If inflation continues to be stubborn, like they say, they may have to get stubborn themselves and raise a lot higher than they want to. So keep that in mind when you're thinking about buying the dip in the stock market because you think the worst is over. It's your money, invest accordingly.